Hello, welcome everybody to today's presentation on 1031 Exchange Basics. My name is Jeff Stechmann, and I am the Business Development Director for Asset Exchange Company. Before we get started, I kind of just like to give you some information on how we're going to handle today's webinar. Don't feel like you have to write every single thing down. You will receive a recording of the webinar today. If you'd like to listen at a future date, feel free. So again, don't feel like you have to write everything down. And also, a lot of the topics that we're going to talk about today, I have in PDF form, just single-page PDFs. If you'd like to receive those PDFs, I'd be glad to email them out to you. My contact information is on the screen, and also I'll mention it again at the end of the presentation, because I find a lot of times, especially if you have a client that has a 1031 exchange need, you really would love to have something you could send to them, and this would be perfect for you. So again, I'll mention that at the end. And also, as far as questions go, I'll open the floor up to questions at the very end, because I find in a lot of cases, if you do have a question, most likely it's going to be answered in an upcoming slide, but if for some reason it isn't, then hey, feel free to ask the questions at the end. There's a box on the right-hand side that says questions. Excuse me, right there is where you would actually type in the question. All right, so it looks like we had a few additional people join since I started. So again, I'll introduce myself again. My name is Jeff Stechmann, Business Development Director, Asset Exchange Company. To kind of give you guys some information about myself, I've actually been in the business for 25 years. I've done just about everything there is to do on the title side of the business. I'm based out of Florida, in the Tampa area, and I've lived in Florida 22 out of those 25 years. I'm originally from New Orleans, so if y'all hear the if you hear the accent come through, please forgive me. Every now and then it rears its ugly head. But you know, being that I've been in the business for as long as I have, you know, I've seen the really good times in the real estate industry, and boy, I've seen the really bad times as well. And you know, hopefully we never have to see those bad times again. I know right now, you know, everything that the country's going through or the world's going through, you know, hopefully we can get through this in the next few months. We can get back to some form of normalcy, and especially in the real estate industry, we can get back to some form of normalcy. So, you know, hopefully you never go back to how it was back in the early 2000s. So, hey, let's just dive right in. I'll give you some information about the company. So, again, we're Asset Exchange Company. And we've actually been in business since 2006. And over the course of our existence, we've done about 30,000 1031 exchanges. So it's all that we do. We don't provide any type of closing services. We don't provide any type of financial services. In the business, in the industry, we're known as a qualified intermediary, so QI for short. Now, other terms you may hear people refer to is an accommodator. Another term is a facilitator, or just simply an intermediary. But, you know, in our neck of the woods, at least here in Florida, you know, people call us QIs. Now, our main job in a 1031 exchange is we actually hold the proceeds from what we refer to as the relinquished property. So that's the property that's being sold in a 1031 exchange. We hold those proceeds on behalf of the seller, the exchanger, because the rule is they can never actually have receipt of those funds. If they do, they lose their ability to do a 1031 exchange. And we're going to talk about that in more details in just the next few minutes. So let me give you a word of caution about QIs. You know, as far as, at least on a national level, a federal level, there actually is no federal agency that oversees what we do. So what does that exactly mean? Well, what that means is anybody out there can actually be a qualified intermediary. There's no guidelines that you need to have any type of E&O insurance. There's no requirements that you have to have any type of bond. There's no guidelines on where you have to, where you hold the proceeds, the type of funds you hold the proceeds in. It's a really scary, scary thought when you think about it. So if any of you guys on the line are currently involved with the 1031 exchange, please just make sure you do your due diligence and you're dealing with a reputable company. Now, great news when you deal with us, right? But we're actually based out of California, and our home office is in San Francisco. And because we're based out of California, well, the state of California actually has a state agency referred to as the California Franchise Tax Board. Now, that Franchise Tax Board actually oversees qualified intermediaries in the state of California. They do require us to carry minimums for the E&O insurance we have. They do require us to carry minimums for the bond that we have. There's guidelines in the financial institutions where we hold those proceeds. There's guidelines in the type of funds we hold those proceeds in. We're subject to audit by that Franchise Tax Board, which is great for anybody that deals with us in California, but anything that we do nationwide, it's great for anybody that we do business with nationwide, because we do exchanges all over the country. That Franchise Tax Board has oversight in anything that we do, because as I mentioned, they could come in our office at a moment's notice and audit any of the files that we're working on, not just the California property, but any file that we're working on anywhere in the country. So great news when you deal with us. As far as our ownership goes, hold on a second. There's somebody that doesn't have audio. If you don't have audio, you can listen to through your computer, or you have a number to dial in along with an access code. So hopefully that helps. As far as our ownership goes, we're owned by two gentlemen. They've actually been in the 1031 exchange business specifically for like 20 plus years, one of which is actually a tax attorney. Now, his name is Adam Skarsgård, and Adam is actually considered a 1031 exchange expert. He's been called upon to testify in tax court regarding 1031 exchange as an expert witness. He even occasionally teaches at UC Berkeley on real estate and tax law, that type of thing. The reason I like to bring his name up is because one of the things that we offer that I don't know of any other QI in the business offers is any of the exchanges that we're involved with, if for some reason they were to get audited by the IRS, we would actually provide free audit support. There's no additional fees for that. We would work hand in hand with the client's CPA, helping to defend the audit, and it primarily would be done by our tax attorney, Adam Skarsgård. So another great reason to deal with us. Now let's talk a little bit about the history of exchanging. So, believe it or not, exchanging has been around for close to 100 years. It really started back in the 20s with farmers, and it was pretty simple back in those days. Maybe I had a farm that I grew corn, and I knew another farmer that he had a farm that he grew wheat. Well, I wanted his farm and he wanted my farm, so all we did is just swap farms, and it was really that simple back in those days. But our modern day exchanges, kind of the format that we follow today, well, that was really started back in 1979. And there was a gentleman by the name of T.J. Starker. Now, Mr. Starker lived in California, and he owned all this land in California with timber on it. And what Mr. Starker did was he sold that land to a timber company called Crown Zellback. And what Crown Zellback did is, in exchange for the land, they gave him what was referred to as exchange credits. And what Mr. Starker did with those exchange credits is, over the course of the next few years, he went out and bought various properties with those exchange credits. So that's kind of how our modern day exchanges started. It started back in 1979 with T.J. Starker. So if any of you guys on the line have ever heard of the term a Starker exchange, well, that's where it comes from. It comes from T.J. Starker's last name. I talked to some CPAs, and I don't know, they've been in the business for, 30, 40 years, and they still refer to a 1031 exchange as a Starker exchange. So yeah, occasionally you may hear the term. Right? But that's where it comes from, T.J. Starker's last name. So when we talk about 1031 tax-deferred exchange, the name is actually derived from Internal Revenue Code Section 1031. And the code states this: no gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment, if such property is exchanged solely for property of like kind which is available either for productive use in a trade or business or for investment. All right. Now, what does all that mean, right? I know that's kind of a mouthful. Well, the code states that property held for productive use in a trade or business. So you can do a 1031 exchange on real property that you use in your trade or business. All right, I'll give you guys an example. Last year we did an exchange for a gentleman that owned a daycare center, right? So he was using that real property in his trade or business, right? So he did an exchange with us. He deferred his taxes, and we're going to talk about that in just a few minutes. And what did he go out and buy as a replacement property? Well, he went out and bought another daycare center. So again, any type of real property that you use in your trade or business, you can use that in the 1031 exchange. You can sell it in the 1031, and you can replace it with any other type of real property that you use in your trade or business. Right now, the next part of the code, where it talks about for investment. So for investment could be something as simple as, let's say you own a single-family residential home, right? Now you hold that for investment. Well, how do you hold it for investment? Well, it's a rental property. So you can sell that rental property in a 1031 exchange, right? Defer your taxes, and what can you buy as a replacement? Well, that's the next part of the code, like-kind property. So what exactly is like-kind property? So like-kind property is any type of real property that you use in your trade or business or that you hold for investment, and you can replace it with any other type of like-kind property that you use in your trade or business or that you hold for investment, all right? So just because you have that single-family residential home that you hold for investment, all right, doesn't mean that you have to replace it with another single-family home, residential home, right? You can replace it with another single family if you want, by all means, but you could also replace it with a duplex, a triplex, a fourplex. You could replace it with vacant land. You could replace it with a commercial strip shopping center, a commercial warehouse, a downtown commercial office building in any metropolitan city in the United States, okay? Any type of real property. As long as what? As long as what you're selling, you're using it in your trade or business, or you're holding it for investment, and as long as what you're replacing it with, you're using your trade or business, or that you hold for investment, right? And those properties can be located anywhere in the United States, including Guam or the U.S. Virgin Islands, right? Puerto Rico is not included in that number. I think the reason Puerto Rico is not included is because they're under a different tax structure than we are here in the States. So I think that's why they're not included, all right? At least that's my understanding, all right? So if any of you guys on the line have ever heard of the term a like-kind exchange, well, that's where it comes from. It comes from that part of the code where it talks about like-kind property, all right? Now, let's see. Okay, now what are current tax rates? Well, typically when you sell real property, you're going to be subject to capital gains taxes, all right? Now, capital gains taxes right now are anywhere from 15 or either 15 or 20%, all right? The 15% has historically been applied if you were single and you had income of less than $400,000 a year, or if you were married and you had income of less than $450,000 a year. That's where you were at the 15%. All right. Now, the 20% kicked in historically if you were single and you had income of greater than $400,000 a year, or if you were married and you had income of greater than $450,000 a year. That's where the 20% kicked in. Now, I think the income levels have changed just a bit. They might be a little bit higher, but either way, the point is you'd still be looking at either 15 or 20% capital gains taxes when you sell that real property. Now, also what you would be subject to is another tax. It's referred to as depreciation recapture tax, right? That's an additional 25% tax. Now, how does that work, right? Well, the depreciation recapture tax works like this. Any depreciation that you've claimed in the property, the total depreciation for the entire time that you've owned it, when you go to sell that property, you're going to be hit with a 25% depreciation recapture tax just on the depreciation alone. All right. Now, on top of that, you may also be subject to what they refer to as the Medicare tax, right? That's an additional 3.8% tax. Now, what exactly is that, right? Well, that was passed back in 2010 with the Affordable Care Act, Obamacare, right? It went into effect in 2013. It was one of the things that they passed to try to offset some of the costs of the Affordable Care Act. Right? So when you do a 1031 exchange, you can defer having to pay any of these taxes. All right. Now, what am I not listing up there in the slide? Well, I'm not listing anything to do with state income taxes. All right. For those on the line that are located here in Florida, right? Well, Florida, we don't have state income taxes, so we don't even need to worry about that. But if we live in a state, or if we were selling property in a state that has state income taxes, we would also be subject to state income taxes as well. When you do a 1031 exchange, you can also avoid having to pay the state income taxes. Now, every state kind of has their own procedure or some type of form that you have to complete. You have to submit it to the state in order to get out of having to pay the taxes, all right? But it can be done. So that's the other great news with 1031 exchange. You can avoid paying any of these federal taxes, right? And also potentially the state income taxes if you live in a state that has state income taxes, or if you're a citizen, say you're a citizen in Florida with no state income taxes, but if you're selling a property, let's say in a state like California that has state income taxes, you can also avoid having to pay those taxes, because even though you're a Florida resident, the state of California is still going to want their taxes. You can also avoid having to pay those taxes, all right? So let's talk a little bit about intent to hold for investment. Now, I get this question all the time. People will ask me, they say, well, Jeff, how long do I need to hold on to a property for it to be considered investment? And, the honest answer is, I don't know, because there's nowhere in the code that states how long you need to own a property for it to be considered investment. All right, it just states that you need to use a property in your trade or business, or you have to hold it for investment. Now, if you ask some CPAs, they'll tell you, really a good rule of thumb is you really need to hold on to a property probably for a year, for 12 months. And if you think about the logic behind that, just for 1 minute, right? If I buy a property today, right, I buy an investment property today. Now I'm going to hold on to it for a year, right? So I'm going to claim it as investment property in my 2020 taxes, right? Now I'm holding it for a year, for 12 months, right? I'm also going to claim it as investment property in my 2021 taxes, right? So I'm actually going to be claiming that property as an investment on two tax reporting years, filing years, right? Is that a good rule of thumb? Well, you know what? The answer is maybe, all right? Some other CPAs will say, well, really a good rule of thumb is you really need to hold on to the property for a minimum of 24 months, for at least 24 months or 2 years. Because one of the thinkings behind it is, we're going to talk about it in the very next slide. Back in 2008, the IRS came out with guidelines regarding vacation homes. And in those guidelines for vacation homes, they stated for a vacation home to be considered investment property, you must own the property for a minimum of 24 months or 2 years, right? So some CPAs pick up on that and they say, well, for vacation homes, the IRS has given its guidelines that for that vacation home to be considered investment property, you must own it for 24 months or 2 years. Therefore, any type of investment property, you really need to hold on to it for 2 years or 24 months, right? But, the reality of the whole thing is, it's not really about so much how long you own the property. It's more so about your intent, all right? And your intent is this. Did you advertise the property for rent? Did you advertise it for fair market value rent? If fair market value rent is $1,500 a month, and you're advertising it for $5,000 a month, you know what? IRS may have an issue with that, right? Did you show it to potential renters? If you get audited and the IRS comes in and says, "Hey, prove to us you held that property for investment and not for sale," all right, you're going to have to be able to back it up, all right? And you could back it up in the example. You could say, look, here's where I marketed it for rent. Here's what I listed it for rent for fair market value. Here's where I showed it to potential renter, right? Again, if you get audited and the IRS comes in and says, prove to us you held that property for investment, you're going to have to be able to back it up. All right. Now, I'll list one particular court case, Resnick versus the commissioner. In that particular court case, the circumstances was he had a husband and wife, all right? They owned a single-family residential home. That was their primary home. They also owned another single-family residential home that was an investment property, a rental property. So what they did was they sold that rental property in a 1031 exchange, and the replacement property that they bought was another single-family residential home, all right? That was going to be the new investment property, the new rental property. Now, 6 months after they did their exchange, during that 6-month period, they advertised the property for rent in the town newspaper that they lived in. They advertised it for fair market value. Now, they actually showed it to 2 potential renters, but for whatever reason, they could never get the thing rented. Okay? Now, what else happened during that 6-month period is one of them loses their job. All right? Now, they had a mortgage on their primary. They also had a mortgage on that investment property, but what? The investment property wasn't rented out. So after 8 months of ownership, they sold their primary and they moved into their investment. Right? In that particular court case, it was ruled that their intent for that investment property was to hold it as an investment. But what happened? Their circumstances changed and they had to do something. So again, it's not about how long you own the property. It's more so about your intent. And if you get audited, you're going to have to be able to back it up. All right? Now, let's see here. Okay, so vacation homes, all right? I always like to talk about vacation homes because why? Well, because I know a lot of us on the line live in Florida, all right? And in Florida, everybody has a vacation home, it seems like, or everybody wants a vacation home, it seems like, right? So how does that vacation home qualify as an investment property, right? And this is actually referred to as Revenue Procedure 2008-16, all right? Now, the first guideline I've already mentioned to you guys, you must own the property for a minimum of 24 months, all right? So for 2 years. Now, for every 12-month period of ownership, all right, you must rent the property out at fair market value for a minimum of 14 days, all right? You can use it for some personal use, all right? For every 12-month period of ownership, you can actually use the property for 14 days personal use, or 10% of the total time that it was rented. So let's just say during that 12-month period, right? Let's say you rented the property out for 200 days, all right? So 10% of 200 would be what? Would be 20. So you could use the property for 20 days personal use instead of the 14, all right? If that property meets those guidelines, it qualifies as an investment property. And hey, you can use it in a 1031 exchange. Now, if it doesn't meet those guidelines, I wouldn't necessarily say it would be disqualified, all right? In that case, I would recommend to the client, say, look, talk to your CPA. And if you and your CPA can come to an agreement where you feel like you can justify it as being that property as being an investment property, then hey, by all means, use it in a 1031 exchange, all right? We're always going to recommend to people, talk to your CPA, because why? Because your CPA is going to have way more information about your tax situation than I ever would, that I would even ever want to know, all right? If the CPA comes back and says, hey, I feel like we can justify it as being an investment property, you know what? We move forward in the 1031 exchange, all right? I have a great PDF just on this vacation homes too, as I mentioned in the beginning. So again, I'll mention it at the end. If y'all want those PDFs, let me know, all right? Okay, so who can actually do a 1031 exchange, all right? So with 1031 exchange, whoever the taxpayer is in the sale, all right, must be the same taxpayer in the purchase of the replacement property. So individuals can do 1031 exchanges, all right? Husband and wives, spouses. Now, sometimes we see this with spouses. Let's say one of the parties owns an investment property prior to being married. Let's just say it's the wife, all right? Now, She owns let's say it's a rental property, right? So she owns this rental property before marriage. She gets married, and then during the course of the marriage, she says, you know what? I want to sell the rental property. I want to do a 1031 exchange because I want to defer my taxes, and I want to buy another replacement property, right? But in order to buy that replacement property, that investment property, she needs to get a mortgage. She needs to get a loan, and she needs to bring her husband's income to help her qualify for that loan, for that mortgage. So how can you do it when you do a 1031 exchange, right? Well, one possible solution would be this. There's a type of ownership that's referred to as tenants in common. Now, for those of y'all on the line that don't know what tenants in common is, basically the way it works is tenants in common ownership is you can own a certain percentage of the property. So each person or party can own a certain percentage of the property. So in the case with the husband and wife, with the wife needing to get the mortgage, bring the husband in to get the mortgage, you might be able to do something like this. You'd have to get the lender's approval because the lender has to approve everything, but you maybe could bring in the wife as like a 99% tenant in common owner, and you bring the husband in as like a 1% tenant in common owner. Now, again, if the lender would go for those terms, and hey, you could move forward, get the loan, and she could get that replacement property, get the loan on that replacement property, all right? So that brings me to the next point. Tenants in common owners can do 1031 exchanges as well, all right? So I'll give you guys an example. Let's say I want to go out and I want to buy an investment property, right? Well, but I want to bring somebody else in with me to help me buy it, all right? And we're going to set it up where we're going to be tenants in common owners, where I'm going to own 50% and he's going to own 50%, all right? So we go out, we buy this property together, an investment property, as tenant in common owners. Now, we own the property for years. And at some point, we said, well, you know what? We want to sell the property, right? Now, for me, I'd like to take my 50% tenant in common ownership. I'd like to do a 1031 exchange so I can defer all of my taxes, and I want to buy another replacement property, another investment property, right? But my other tenant in common owner, he says, you know what? I have no desire to buy any more investment properties. I'm fine with just cashing out and paying whatever taxes are due that I have due, right? Well, he can do that, right? And I also have the option to do what I want, okay? If I want to do a 1031 exchange, I'll by all means do it, defer my taxes, and go out and buy another investment replacement property. He could do his own 1031 exchange if he wanted to, and defer his taxes and buy an investment property on his own if he wanted to. All right. So again, tenant in common owners can do 1031 exchanges. Any type of legal entity that owns real property can do 1031 exchanges. LLCs, corporations, partnerships, trust. Sometimes we see this with LLCs. Let's say you have a single member disregarded LLC. Now, disregarded meaning that for tax purposes, that entity, that LLC, that single member LLC, doesn't file a separate tax return. Anything to do with that that entity, that disregarded entity, that LLC, you just put everything on your personal taxes, right? Now, some of you guys on the line, especially if you're in real estate, it's common that realtors will have their own single member LLCs, right? And at the end of the year, when they file their taxes, well, they don't file a separate tax return for that LLC. They just put anything to do with that LLC on their personal taxes. Well, and that's referred to as a disregarded entity, because for tax purposes, you as an individual and your disregarded entity are one and the same. All right, so back to 1031. So with that disregarded entity, if that disregarded single member LLC sells real property in a 1031 exchange, all right, the replacement property can be in the name of the individual, or it could be in the name of the single member disregarded LLC. Because why? Because again, for tax purposes, that individual and that LLC are one and the same. All right, now, if it's a multi-member LLC, a partnership, a corporation, okay, If it's what's referred to as a regarded entity, regarded meaning that the actual entity files a separate tax return, well, if that entity sells the real property in a 1031 exchange, that same entity, regarded entity, needs to be the purchaser of the replacement property, all right? Because with 1031 exchange, again, whoever the taxpayer is in the sale of the relinquished property needs to be the same taxpayer in the purchase of the replacement property, all right? So hopefully everybody understands that. All right, so 1031 exchange guidelines. All right, the basic requirements for a 1031, the property qualifications. All right, we're going to cover that. We're going to talk about the tax deferral requirements. We're going to talk about some timelines everybody needs to be aware of. And we're also going to talk about some identification rules, okay? So let's talk about the recap. I know a few people joined a little bit late. What type of property can you do 1031 exchanges on? Any type of real property that you use in your trade or business or that you hold for investment, all right? You can sell that in an exchange, and you can exchange it for any other type of real property, like-kind property, that you use in your trade or business or that you hold for investment, all right? It doesn't matter if you're selling residential property. You can buy any type of replacement property, residential, single family, multifamily, commercial, it doesn't matter, right? As long as what you're selling, you're using your trade or business, and as long as what you're replacing it with, using your trade or business or you hold for investment. What you're selling, you use a trade or business or hold for investment. Has to be the same thing what you purchase, all right? And those properties can be located anywhere in the United States, including Guam or the U.S. Virgin Islands, all right? Again, what's not included? Puerto Rico, right? Puerto Rico's not included in that number, all right? Again, if y'all have ever heard of the term a like-kind exchange, that's where it comes from. It comes from that part of the code, which we've already covered, where it talks about like-kind property, all right? Properties that are excluded from 1031 exchange, all right? Your primary home, primary residential home. You can't do a 1031 exchange on your primary, all right? On your primary, you may qualify for what they refer to as a Section 121, all right? And the way the 121 works is basically you had to have lived in the property as your primary for at least 2 years, all right? And when you go to sell your primary, if you're single and you have any gain in the property, all right? If you're single, the first $250,000 of any gain is tax exempt, and if you're married, the first $500,000 of any gain is tax exempt. All right, tax exempt meaning you never have to pay it. All right, it's not like a 1031 exchange where it's a deferral. Well, with the 121, it's an exemption. You're one and done. All right, now what are the properties excluded from 1031 exchange? Well, property held for sale is excluded from 1031 exchange. So give you guys an example. Let's say I'm a builder, right? So I know in the state of Florida, we have a lot of these national home builders like Pulte Homes, KB Homes, Lennar Homes, all right? Let's say I'm Pulte Homes. Now, Pulte Homes is one of the largest single-family residential home builders in the entire country, right? They build properties in multiple states, right? They're all over the place. Now, the properties that they build, when those properties are completed, what do they do with them? Well, they turn around and sell them, right? Because they're holding those properties for sale and they're not holding them for investment, well, they can't do 1031 exchanges on those types of properties because they're properties that they're holding, they're properties being held for sale and not for investment, all right? Dealer property is excluded from 1031 exchange, all right? I'll give you guys an example for dealer property. Let's say I'm a flipper, all right? Somebody that buys a property, 2 or 3 months goes by, they fix it up, and then what do they do with it? Well, they turn around and sell it, right? Well, you can't do 1031 exchanges on those types of properties, all right? Because that's like their business. That's like their inventory. They're fixing those properties up and then they're turning around and they're selling them, all right? Well, you can't do 1031 exchanges on those types of properties. Right now, here's an example. What if I'm a flipper and let's say I buy a property and 2 or 3 months goes by, they fix it up, and instead of selling it, they go to their realtor and they say, hey, can you put this in the MLS system, show it for rent? Let's put it in there for fair market value rent as well. That's a little different, right? Because why? Because now all of a sudden they're showing their intent that they're holding it for investment and they're not holding it for sale, right? I don't know. Who knows? Maybe they even show it to a potential renter. Hey, they run a credit report on the potential renter. They have horrible credit. And you know what? They decide not even to rent the property to them, right? Again, it's all about your intent. If that flipper gets audited and the IRS comes in and says, hey, prove to us you held that property for investment and not for sale. Well, in my example, they could easily do that. They could say, look, here's an email that I sent to my realtor saying put it in the MLS for rent. Here's the day it went into the MLS for rent. Here's the MLS listing showing it for rent, showing it for fair market value rent. Here's the day we showed it to a potential renter. Here's the day I ran the credit report. All of that type of stuff is going to be their backup, right? It's going to be their ammunition, their trail of breadcrumbs to prove that they held the property for investment and not for sale. All right. If they just strictly fix the property up and turn around and sell it, you can't do a 1031 exchange on that type of property. All right. All right. So foreign property is excluded from 1031 exchange. Now that might be pretty obvious, but like I couldn't sell a property, let's say here in Florida in a 1031 and then try to buy replacement property somewhere in Canada or Mexico or Europe. Okay. It has to be what? Domestically located property, including Guam or the U.S. Virgin Islands, all right? So foreign property is excluded from 1031 exchange, all right? Guideline number 2, the tax deferral requirements, all right? So in order to get a full deferral, to defer your taxes 100%, okay? Rule number 1 is you must reinvest all of the net proceeds in property of equal or greater value. Now, what are the net proceeds? Well, that's the cash, all right? That's the cash that normally you would get out of the closing, all right? Now, we're the qualified intermediary, the QI. We're going to hold those proceeds on behalf of the seller, the exchanger, because the rule is they can never actually have receipt of those funds. If they do, they lose their ability to do a 1031 exchange, all right? So we hold the proceeds on their behalf, all right? And they have to take the entire amount and they have to go out and they have to buy a replacement property, or it can even be a combination of properties equal to or greater than whatever the sales price was on the property that they sold, the relinquished property, right? That's rule number 1. Now, rule number 2 is you must acquire an equal amount or greater debt. What exactly does that mean, right? Well, what that means is if you have a loan that you're paying off, all right, you have to get a loan of at least that amount or greater in any replacement property or properties. Now, that rule can actually have an exception, all right? If you happen to have cash that you can add to the purchase of the replacement property, you can offset having to get any additional debt or acquire any debt at all right? Now, obviously, if you have no debt, if you don't have a loan that you're paying off when you sell your relinquished property, well, you're not going to be required to acquire a loan to help you buy the replacement property, all right? But if you need to, if you want to, you always have the option. You can acquire debt. You can get a loan if you need to help you buy the replacement property or properties, all right? That's the rules, all right? Guideline number 3. There's some timelines everybody needs to be aware of, all right? So when you when you sell your relinquished property, all right, you're going to have 180 calendar days to purchase any replacement property or properties. Now, that's calendar days, okay? That's holidays, that's weekends, all right? For those on the line that live in Florida and some of the other states throughout the East Coast of the United States, right? Or even the Gulf Coast, there's certain times of the year where we're going to be susceptible to hurricanes, all right? That's from June to the end of November. Hey, if we're getting hit with a hurricane and everything shuts down for a day or two or a week, whatever it may be, it does not matter. That clock is still ticking, all right? So it's 180 days to close to purchase any replacement property or properties, all right? Now, the first 45 days of the 180, all right, That's referred to as the identification period, all right? Now, what is all that about, right? How does that work? Well, the way that works is you must identify any potential property or properties that you want to buy, that you potentially want to buy, all right? That's something else that we're going to assist with, all right? We're going to provide to the client, the exchanger, an identification ID letter, all right? And on that form, there's going to be blank lines, all right? And it's going to have to be specific to a property address or addresses, all right? Now, if they're buying a property, let's say they're buying vacant land and there is no property address, there's only a legal description. Well, we need that. They're going to have to complete the form, sign off on it, get it back to us by midnight of the 45th day. That's how they will formally identify their replacement property, all right? Those properties do not even have to be under contract. None of them have to be, all right? You just have to identify any potential property or properties by midnight of the 45th day, all right? But the thing is, if you happen to find the perfect property, let's say on day 46, all right, it's too late, all right? So whatever you put on that form by midnight of the 45th day, you better make sure you're going to be able to buy at least one of them, all right? Let's say you identify 3 properties by midnight of the 45th day, all right? After midnight of the 45th day, one of those properties burns down to the ground, all right? One of them gets sold, all right? You identified 3, right? You only have an opportunity to buy that one other property, all right? So again, 180 days to close. The first 45 days, you have to identify any potential property or properties, all right? The only time that the IRS grants any type of extensions to these rules, and if they do it at all, okay, there's no guarantees that they're going to do anything, but typically it has to be some type of federally declared disaster, all right? Right now, latest update, hot off the presses, as of Thursday, April 8th, with the COVID-19, everything that's happened with the coronavirus, right? The IRS just granted some additional extensions, okay? There's extensions that have been given for the 45 days and also for the 180. This is what they are as of today, okay? If your 45th day falls between April 1st and July 15th, okay? Now your 45th day will be extended to July 15th, all right? So if it falls anytime between basically April 1st and July 14th, your new 45 day period is going to be July 15th, all right? If your 180 day, okay, falls anywhere between April 1st and July 14th, okay, your new 180th day is now July 15th, all right? That's as of today. Now, things could change tomorrow, okay? All of this stuff is new. I'll give you all an example of how the extensions are going to work or currently working. Let's say taxpayer Bob sold his property on March 1st of this year, okay, 2020. Now, normally, his 45th day would have been April 15th, okay? That's where his 45th day would have ended. But now with the extensions, now his 45th day gets extended to July 15th, all right? How does the 180 work? Here's an example. Let's say taxpayer Sue sold her property last year, on October 4th, 2019, okay? Her 180th day would have been on April 1st of this year. Okay, now with the new guidelines, because it falls between April 1st and July 15th, her 180th day is now July 15th. All right. Hopefully everybody understands that. And again, all of this stuff could change. They just came out with this on April 9th. Some of the things we're still waiting on additional clarifications, but that's what's happening right now, because everything is basically on at a standstill right now as far as, you know, people will be able to show properties, view properties, that type of thing. So they're tying in the July 15th date. I think it's probably more so, you know, your tax returns, you're not required to file your tax returns until July 15th right now either. So that's what's going on right now, but I just wanted to give you all the latest information, all right? All right, let's talk about guideline number 4. there's some identification rules everybody needs to be aware of, all right? So there's 3 different rules, okay? Now, I'm going to read all 3 of these rules to you, okay? I'm going to read each one of them to you. Now, if you don't quite understand them when I read them to you, don't worry about it, okay? Because I have 3 different examples that I'm going to show you how each rule works, all right? The way the numbers work, all right? So let's dive in, all right? The first rule, and this is probably the most popular rule that we see, all right? Probably 90 to 95% of all the exchanges that we do fall under this first rule, and it's referred to as the 3 property rule, all right? And the 3 property rule states this: you can identify up to 3 properties without regard to the fair market value of those 3 properties. So what exactly does that mean, right? Fair market value. That means as long as you identify 3 properties or less, okay, the purchase prices, the fair market value, the purchase prices of any of those properties can be any dollar amount. It does not matter as long as it's 3 properties or less, all right? Now, if you want to identify more than 3 properties, you can do that, all right? But you're going to fall into this next rule, all right? It's referred to as the 200% rule, all right? And what that states is you can identify over 3 properties, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold, all right? So what exactly does that mean? Well, what that means is if you identify more than 3 properties, the combined purchase prices of all those properties that you've identified cannot exceed 200% or 2 times whatever the sales price was on the property that you sold, the relinquished property, all right? Now, if that doesn't make sense to you, again, don't worry about it because I'm going to give you an example and hopefully it'll click by then, all right? Now, if you want to identify more than 3 properties, and you also want to exceed that 200% rule, well, you can do that, all right? But you're going to fall into this next rule. It's referred to as the 95% rule. Now, the 95% rule, it doesn't make a lot of sense, all right? We don't see this rule even being enacted that often, but it does exist, all right? And again, as I mentioned, it really doesn't make a lot of sense, but remember, everybody, this is the IRS, okay? And sometimes this stuff just doesn't make sense, okay? So let me read it to you guys. All right, so you can identify over 3 properties, and you can exceed the 200% rule, all right? But you must acquire at least 95% of the value of all the properties that you identified. Now, I know that's probably about as clear as mud, right? Let me show you the examples of how everything works, especially for this one, and hopefully it'll click for you, all right? So here's how the 3 property rule works. Again, if you identify 3 properties or less, the dollar value can be any amount, all right? The purchase price can be any amount, all right? So here we go. Let's say we sell for $1 million, all right? Now we go out and we identify 3 properties, all right? Because we've identified 3, we're in the 3 property rule, all right? Let's just say we're going to be buying each one of those for $1 million each, all right? So we've identified $3 million worth of property. Now, we could be buying each one of those properties for $10 million a piece. It doesn't matter, right? As long as we say 3 properties or less, okay? They can be any dollar value, all right? It doesn't matter. But what does matter, and I'll say it again, all right? If you identify 3 properties, well, you better make sure you're going to be able to buy at least one of them, right? Now, what's the best way to lock up a property? Is to put one of those properties under contract. So that's generally what we see, all right? Is that somebody will put one property under contract, and that's one of the properties they identify, right? Now, they maybe will identify 2 additional properties that aren't under contract because what happens is after midnight of the 45th day, let's just say if that property that they have under contract, if that whole contract falls apart, well, at least they have those 2 other properties that they can buy because they would have identified those 2 other properties by midnight of the 45th day, all right? So, again, 3 property rule, they can be any dollar value, all right? But again, you better make sure you're going to be able to buy at least one of them, all right? Now, Guideline, the 200% rule, right? Now, the 200% rule states that, hey, if you want to exceed the 3 property rule, you can, but you cannot exceed 200% or 2 times the combined fair market value of the property being sold. All right, so here's how it works. Let's say we sell a property for $4 million again. Now we go out and we identify 5 properties, all right? Because we've identified 5 properties, we've exceeded our 3-property rule, right? So that puts us into the 200% rule. So what does that mean? Well, that means is the combined purchase prices of all 5 of those properties, all right, cannot exceed $2 million. Now, where am I getting the $2 million from? Well, we sold for $1 million, right? 200% of $1 million that we sold, or 2 times $1 million that we sold, is how much? $2 million. So that's where we get the $2 million from. So that's the 200% rule. All right, that's pretty straightforward, I think. Hopefully everybody gets it. All right, now here is the 95% rule. All right, now this is where you exceed the 3-property rule, you exceed the 200% rule, but you must acquire at least 95% of the value of all the properties that you've identified. All right, so here's how it works. All right, again, we sell for $1 million. But this time we go out and we identified 10 properties, all right? Because we've identified 10, we've exceeded our 3-property rule, right? Right? Now let's just keep the math simple. Let's say we're going to buy each one of them for $1 million a piece, right? So we've identified $10 million worth of property. Well, because we've identified $10 million worth of property, we've actually exceeded our 200% rule, because that was how much? $2 million, right? So that puts us into this 95% rule. So in our example, if we only acquire 9 out of the 10 properties, right, that's only 90%, or $9 million, right? That's not 95%. So if we do that, if we only acquire 9 out of the 10 properties, we actually blow our entire exchange and we have to pay all of the taxes, right? So the 95% rule in reality is 100% of whatever you identify, you're going to have to buy. All right, and we're using really simple numbers too, right? We're saying everything's going to be $1 million a piece, nice and even. Well, you know what? Those purchase prices are going to be all over the map. It's going to be really hard to sit down and say, okay, let's see. If I get this property, oh wait, that only puts me at 93%. All right, maybe I need to make sure I get this other property. Oh, that's only 94%. Hey, 95% rule is 100%. Of whatever you identify, again, you're going to have to buy. All right. The IRS wants to limit you in how many properties you can identify. All right. They don't want you identifying everything under the sun. You know why? Because if you identify everything under the sun, guess what? You're going to have to buy everything under the sun because of this crazy 95% rule. All right. So hopefully everybody gets that. All right. So how does this whole process work? How does the whole closing process work? All right. Well, we really start doing our thing once a contract gets signed on the property being sold, the relinquished property, all right? Because I need to get a copy of the contract, all right? I also need to find out who's going to be handling the closing, because what happens is we reach out to that company, all right? And we get a copy of the title search, the title commitment, all right? So once we get that title commitment in, that title search, and also the contract, then what we do is we turn around and we prepare what we refer to as an exchange agreement, all right? And those are basically documents that set the exchange up, all right? All right, those documents are going to be signed at the closing of the relinquished property, at the sale, all right? Because what happens in that transaction is we're going to step into the shoes of the seller, right? And that's the way we're able to take those proceeds, whoever's handling the closing. They're going to wire those proceeds over to us, and we're going to hold them on their behalf, the seller or the exchanger's behalf, right? So that transaction happens. And then the clock's going to start ticking, right? 180 days to close, 45 days to identify. We're sending out the identification letter, right? The client's completing it. They're getting it back to us by midnight of the 45th day, all right? Once they get a contract in on the replacement property, all right, we need to get a copy of that. We also need to find out who's going to be handling that closing, right? Because if you think about it, hey, we're holding all these proceeds from this sale, right? We need a contact person. We need their wiring instructions. We have to know where to send those proceeds, right? We're going to prepare some other documents that are going to be signed at the purchase of the replacement property, all right? Because in that transaction, we're going to step into their shoes as the buyer, All right, and that's the way we're able to take those proceeds. We're going to wire those proceeds over to whoever's handling the closing, a title company, escrow company, attorney, all right? And that's the way we're able to help them purchase that replacement property, all right? That's it. That's the entire closing process. It's not that complicated of a process. Just everything leading up to it is the complicated stuff, right? Got to figure out what you want to buy. You got to identify stuff by 45 days. You got to make sure you get one of them under contract to secure the probability of you getting it. All right. You have to get a loan. Do you have to get a loan? Do you have cash that you can add to it? All right. That's all the complicated stuff. All right. But the actual closing process is the more simpler stuff. All right. Now, what are our fees? Well, everything that we talked about today, which is the most common type of exchange that we do, is referred to as a delayed exchange, right? And a delayed exchange is everything we talked about, all right? That's where you actually sell first and then you buy last, right? So you're selling your relinquished property, right? Clock starts ticking, 45 days to identify, a total of 180 days to close, and you're purchasing last. You're purchasing your replacement property by day 180, all right? That's a delayed exchange. Probably 90 to 95% of all the exchanges we do are delayed, all right? What is our fee? Well, we charge $750 on the sale, right? We don't collect anything until it physically closes, all right? For those of y'all that are realtors that are on the line, we're just like you guys, all right? You don't earn your commissions until the property sells. Well, neither do we. We don't earn anything. Our fee is not incurred until it physically closes. All right. I mentioned to y'all the process. If we get a copy of the contract and we do everything we need to do, all the documents are prepared, ready to be signed for the closing, and the contract falls apart and the thing never closes. Well, we don't charge any kind of cancellation fees, all right? We don't charge any type of wiring or junk fees, anything like that, all right? So $750 on the sale, and then when they buy the replacement property, we charge $250, all right? So you sell one property, you buy one property, hey, our total fee is $1,000. That's it, all right? It can be a $100,000 deal. It could be a $100 million deal. Doesn't matter. That's our fee. Sell one, buy one. Our total fee is $1,000. All right. Now, there's a few other type of exchanges. I don't have time to go into them today. This is just a basics class, right? But I'll give you other fees anyway. All right. There's one that's referred to as a reverse exchange. All right. That works just the opposite of a delayed. It's actually where you buy first and you sell last. Okay. They can be extremely complicated. All right, we have to form an LLC. We go on title. All right, those start off at about $6,500. All right, there's another type of exchange referred to as a construction or an improvement exchange or a built-to-suit exchange. All right, those can be really complicated as well. That's when you sell your relinquished property. You find a property that you want to buy, but you want to do some improvements before you actually acquire it. Well, again, we form that separate company, that LLC. We go on title. We can use the proceeds that we're holding to oversee the construction, to pay for the construction. We're working with contractors, working with them disbursements, whatever, when they need to be paid, all that type of stuff. Those start off at about $6,500. That reverse exchange, the construction improvement exchanges, again, not a lot of time to go into them today. I do have another class coming up later this month. It's actually next week. It's going to be next Wednesday on the 29th. It's an advanced 1031 exchange, all right? I'm going to have that one from 11 to 12:15 Eastern, all right? If y'all want to join in on that class, it's kind of a continuation of today's class, all right? I didn't have a lot of time to talk about a lot of the numbers today. In that class, we do, all right? We talk about how to calculate what your taxes are. We talk about the reverse exchanges. We talk about the construction exchanges. We talk more about entities, LLCs, how to handle what some of the issues that partnerships run into, all right? If y'all can join next week, please RSVP for that class, register for that class. We're going to cover some of the basics again because some people don't attend this class, but feel free to join in. All right. We're also going to talk more about that 121, which you do for your primary. We even talk about how to convert that over to an investment property where you can use it in a 1031 exchange. All right. We talk about boot. We didn't cover that today. Mortgage boot and cash boot. All right. Again, it's next Wednesday, advanced 1031 exchanges from 11 to 12:15 Eastern Time. If you received today's information to register, you should also have received the one for the advanced class. If not, hey, shoot me an email, and I'd be glad to get the information out to you. All right, we're just about out of time. Reason so is, I covered the COVID stuff, the COVID-19. I just wanted y'all to have the latest information. I'm going to open the floor up to questions. All right. If y'all have any questions, there's a box that says questions. Go ahead and feel free to type them in. While we're waiting for the questions to come in, I will say this. Again, if you'd like to have any of those PDFs I mentioned, a lot of the topics that we talked about today, I have in PDF form. I'd be glad to email those out to you guys. Please just shoot me an email, let me know, or give me a call. Also, if you have clients that have 1031 exchange needs, or you as an individual, if you're an investor as well, and you want to talk, or you want me to talk to your clients, feel free. Reach out to me, let me know. I'll send you the email with the PDFs. You want to forward that on to your client, CC me, no problem. I mean, by no means are you going to be a 1031 exchange expert. I talk to people about 1031 all day long, all right? I'd be glad to talk to your clients and talk to you individually. Again, you should receive an email later within the next day or so with a recording of today's presentation. So let's see if we have anything coming in. Okay. Well, one person couldn't hear anything. It seemed like everybody else heard fine. So thanks for hanging in there. I'll reach out to the person that wasn't able to hear. Okay. Vacation homes. What is the vacation home announcement link or article? Was it called? What year? It was on the slide. I think you asked that before. Jeff, you had asked that before. I covered that slide. That's why I was mentioning a lot of the questions I probably was going to answer. It's referred to as Revenue Procedure 2008-16. That's the Vacation Homes Revenue Procedure, RevProc 2008-16. But I have the PDF that I'd be glad to email over to you, Jeff, if you'd like. It came out in 2008. That's why it's called 2008-16. Please send me PDFs about this webinar. Thanks. All right. Marlita. All right. Webinar typo. All right. I'm not sure what that means. Jeff, got it. Okay. You're welcome, Jeff. And if you have any questions, hey, just feel free. If you have something specific, feel free to shoot me an email, give me a call. We can talk. All right. Anybody else? Do you have a form, an LLC, to avoid the taxes? Oh, no, not at all. As I mentioned, any type of entity can do an exchange. Individuals can do 1031 exchanges. I mentioned that on the slide. Individual persons, married couples, tenants in common can do 1031 exchanges. LLCs, either regarded or disregarded, can do 1031 exchanges. Trusts, partnerships, corporations, okay, any type of legal entity that owns 1031, that owns real property, or individuals that own real property can do 1031 exchanges. All right. Donald, hopefully that answers your question. Rick, how are losses from a basis sale offset recaptured depreciation? That's way too complicated to talk about right now because we only have a few minutes. Rick, I'd be glad to talk to you offline about that if you'd like. But your recaptured, the depreciation recapture, you can actually defer that when you do a 1031 exchange. In addition to your capital gains taxes, also your the Medicare taxes, any state income taxes that may be due. But we can talk about that in more depth if you'd like, if you want to just give me a call or shoot me an email. All right. Sorry I didn't answer it totally, but it's a little bit more complicated than we have time to cover for today. All right, good. All right, you're welcome. You're welcome, Rick. All right. Anybody else? And look, after we wrap up the call, if y'all think of anything, hey, we can talk. All right. my number's on the screen. You can shoot me an email. We can talk offline. If something pops up, it's like, wait, I should have asked Jeff while we were on the webinar. No problem. All right, especially nowadays because hey, I'm working from the house 24/7, so I'm not out and about traveling throughout the state doing any type of these presentations. I'll mention that too. Once we get back up and running where we can, we can go out. I do have a 2-hour continuing ed class that I teach for realtors. It's approved for Florida real estate agents for 2 hours of continuing ed. I do a lot of those in-house, real estate offices, boards of realtors. I can even do this class too, this basics class and also the advanced class if you wanted to bring me into your office. I cover the entire state of Florida, so I'm usually on the road probably 2 to 4 days a week, but right now I'm doing all these webinars. So, just like everybody else. All right, so I think that's it. No more questions? Well, we're going to go ahead and wrap it up. Hey, guys, I appreciate y'all hanging in there with me today. Glad you could make it. Again, register for the class for next week. It's going to be on the 29th, Wednesday, 11 to 12:15 Eastern Time. Again, we're going to talk more about some of the more in depth on a lot of the issues we talked about today. All right, and I'll go ahead and wrap it up. And let me know if I can do anything for you guys. Please stay safe, stay healthy, and hopefully we will talk in the future. Thanks for attending today. Bye bye.